So, welcome to our today's class. That is financial accounting. And now for today's class, we still continuing with our blogs revision. And for today's class, I'm going to revise on the company account. Company account. That is what we'll be able to talk about today. That is what we'll be able to talk about. We'll talk about the company account. Company account. That is now what we'll be able to talk about. Now, when we talk about a company, in this case, you know, is a voluntary association of individuals, which in this case, their aim is to make a profit. So in this case, this is also what we call the financial statements of a company. And what you need to know in company accounts, there are three things that you need to be aware. Number one is on the types of companies. And when we talk of the types of companies, in this case, they are in two. We have public companies and we have what we call the what? Private companies. When we talk of public companies, in this case, are those companies that can invite the members of the public to invest on what we call the shares. Now, when we talk of shares, we'll also be able to categorize the shares. That is, we'll also be able to talk about the share capital of a company. So when we talk of a public company, they can invite the members of public like you to invest on their shares. When we talk about the private companies, these are those companies that cannot invite the members of the public to invest on their shares. When we talk of shares, remember, they are listed. We are just talking about those companies that are listed on what we call the stock what? The stock exchange. The companies listed on the stock exchange are the companies we call in the public companies, because those are the companies that can invite the members of the public to invest on their shares. Then we have the private companies. These are those companies that are not listed on the security exchange. That is the stock exchange. And what we mean in this case, these companies cannot invite the members of public to invest on their shares. What we mean when we talk about the shares here. Now, share capital of a company. Now, when you talk about share capital of a company, is normally divided into what we call shares. So in this case, hapa si mali kama for example for the sole trader, mali utatoa pesa yako uende ununue vitu ndo uweze kuinvest to start a business. No. Now, for a company, in this case, the capital of a company is normally divided into what we call in shares. Whereby in this case, for the shares, they are normally in two categories. There is what we call the ordinary shares, and then we have what we call the what? Preference shares. Now, when you talk of the ordinary shares are now the common shares, which in this case, these are those shares, once you are issued, you have the right of ownership, or generally, you have the control over the company. But the only limitation to this one is that the dividends, remember, for the shareholders, once you give out or you buy the shares, what you are waiting to receive is the dividends. Dividends in that case is now the profit that you will be getting out of the shares that you have bought. So for them, what they will be expecting is the dividend. But for the dividend in this case, for the ordinary shares, it will only be paid when the shareholders have done, the directors have done what? Declared. And therefore, the owner of ordinary shares is having a right to vote and is also having control over the company. So huyu ndo utampata kwa annual general meeting because he will have to attend for that annual general meeting. But now, when we talk of preference shareholders here, now these ones. Now, the preference shares in this case, these are shares that earn a fixed rate of dividend. They earn a fixed rate of dividend, meaning that the dividend, whether you are having profits or not, it must be paid. But however, in this case, the preference shareholders will not have any right to vote over the vote. They will not have any right to vote over their shares. So that is what we mean in this case. So for preference shareholders, they will earn a fixed rate of dividend irrespective of what the company is making. So hata kama the company is having profit ama imekosa to make profit, they have to pay the preference shares. So the preference shareholders will not have any right to vote over their shares. And now they will not attend the annual general meeting. Because in this case, they do not have any right to vote. And however, again, they do not have any control over the company. That is now what we mean when we talk of preference shareholders. Then, for the other thing that also you need to know, we've talked about the share capital of a company. Now, whereby we have in the ordinary share capital, and then we have the preference share capital. Now, there is a way whereby the share capital of a company generally, when we talk of the issue of shares. Now, remember, for the issue of the shares here, the company is the one that is supposed to issue the shares. Are we together? And that's why when we talk of, there is one accounting concept we call the business entity concept, where a company is regarded to be separate from its owners. Whereby if I talk of the company will give you the shares, you become an owner, but the transaction that you are going to do, you as the owner, will not be written as transaction of the company. That is what we call the business entity concept. So the company in this case is the one that will now issue the shares to the what? Public. And after issuing the shares to the public, they will issue them at our prices. So in this case, the company can issue shares at what we call at VAR value. At VAR value. That is at VAR value. They can issue the shares at VAR value. They can issue the shares at a premium or issue the shares at a discount. At a premium or issue the shares at a discount. When they issue the shares at a VAR value, is now what they have listed on the securities exchange, the original value, which in this case, we also call it the base value. We also call it the nominal value. That is at the original price. That is what we call the VAR value. Now, when they issue the shares at a price higher than the VAR value, let's say, for example, for a share, they were issuing it at 10 shillings. That is the VAR value. And then in this case, they, instead of issuing them at 10, they issue them at what? 12 shillings. The difference here now, these two, this is now the issue of shares at a premium. a price that is higher than the bar value. And the premium here is of 2 shillings. So in this case, the difference of this amount is normally taken to what we call the share premium account. Share premium account is just like a reserve. That is now what you need to be aware on that regard. Then we have what we call the issue of shares at a discount. Now, when they issue shares at a price that is lower than the bar value, that is what we call the discount. However, this is not allowed on the securities exchange. You cannot issue shares at a price that is below the bar value, what you have listed on the securities exchange. This one will only be allowed when you are issuing what we call the what? Rights issues. And what is the rights issues? Now, rights issue is the method of raising additional ordinary shares by issuing shares at a price that is slightly below the bar value, but this is to the existing shareholders. When you are issuing to the existing shareholders at a price that is below the bar value, in that case, that is now when you can issue at a discount. Because this one you can issue rights issue as a way of paying them dividend. Your difference yenye umekosa kuwalipa dividend, probably you can give them what we call the rights issues. Are we together? And that is what we mean when we talk of issue of shares at a discount. Now, there is now what we call the reserves on the company accounts. Now, reserves number one is now what I've talked about here, what we call the share premium. And when we talk of the share premium, in this case, I've said it will arise as a result of this. Out of the amount that you will issue the shares at a price that is higher than the bar value, the difference in this case, you have to take it to the share premium. Then number two, we also have what we call the general reserve. Now, what is the general reserve? This is whereby you withdraw money out of what you have retained profits to be reserved for the general purposes. So as a result of general purpose, in this anything that may come out in during the operation of the business, in that case, you can withdraw that money. So you will take it out of your earnings to take it to the general reserves. The other one, number three, is now what we call the revenue reserves. Revenue reserves. Revenue reserves, in this case, we can also call them the retained earnings, or we can also call them the retained profits. Now, when we talk of revenue reserve, after now you get the profits, you will now pay the dividends. And the first dividend to be paid is for the preferred shareholders. After that, you can now pay the ordinary dividend for ordinary shareholders. What you will retain after you pay the dividend is now what we call in the revenue reserves, which is also the retained earnings, which is also the retained profits. Are we together? That is now what we mean when we talk of the retained profits. Then the other one that you also not supposed to forget, there is also what we call the revaluation reserve. Revaluation reserve. Revaluation reserve. Now, what is revaluation reserve in this case? Now, let's say, for example, there is this building. You can engage a revaluer who will now come and value this building. That is the revaluer. Akuja aseme, this building is worthy 10 million. But what you had in the cost in this case, that is the original cost of this asset, probably it was around 8 million. Are we together? So where will you take this dividend difference after you revalue this asset? The difference of 2 million, you normally take it to the revaluation reserve. which in this case, that is the amount that you are supposed to keep it on the revaluation reserve, which is part of equity and liabilities. Awesome. Equity and liabilities, you will take the revaluation reserve. That is now on the reserves, and that is what you need to be aware on the same. Now, the other thing we need to know is now the financial statements. The financial statements. The financial statements. Now, financial statements in this case that are prepared here, that are supposed to be prepared on the company account, they are only three. Number one, you are required to prepare the income statement. The income statement. Number two, you are also required to prepare the statement of changes in equity. Statement of changes in equity. And then the third one, you are also required to prepare the statement of financial position. Statement of financial position. Those are the things that you are required to prepare on this case. And I want you to be keen, because on the company account, I want to assure you this one you're not going to miss in this sitting. That is on that company account. So when you talk of the income statement, this is the one that will now show the financial performance of the company as a result of now the profit that is being made. Statement of changes in equity. This one you normally based on the equity items. And the equity items here, they normally comprise of the following. It is just the ordinary shares and all the other reserves. Ordinary shares and all the other reserves zenye nimesema hapa. Share premium, general reserves, the revenue reserves, and all the valuation reserves. So here we'll have and all other reserve. That is now what will comprise. In this case, you don't include the preference shares. Preference shares in this case are not supposed to be included on the what? The statement of changes in equity, because preference shares are not part of equity. Preference shares, nimesema, these are those people who do not have right to vote over their shares, and they do not even have control over the company. So in this case, they normally act as those people that give out loans. If the bank gives you a loan, it will not want to know how you have used that loan. What the bank will be waiting to receive is the interest. Same case to the preference shareholders. They will give you the money. What they will be waiting to receive is only the dividends, which in that case, we said it is at a fixed what? At a fixed rate. That is the statement of changes in equity. And then the statement of financial position, which is now the balance sheet. So we can try an example on the same to understand what you are required to do on that regard. Can do an example on regards to the same. Can do an example, and that is on regards to the financial statements of a company. Financial statements of a company. Now, we can check on this question. We can check on this question in the sitting of September 2015. September 2015. September. For those who are having the CPA paper, I'm using the CPA paper. September 2015. Question number September 2015, and that is question number 2B. September 2015, question 2B. Those September 2015, Question 2B from the CPA paper, September 2015. Question 2B. September 2015. Now I'm hoping we are there. September 2015. I'm using the one for the CPA paper of September 2015. Now, this is what we've been given there. The following trial balance was extracted from the books of Fixen Limited as at 31st May 2015. We have the ordinary share capital. We also have the share premium, 10% debentures, general reserves. We have the revenue reserves. We also have the 10% preference shares, goodwill, inventory, purchases and sales. We've been given the discounts, and we have the salaries, rates and insurance, office expenses, directors' remuneration, interim dividend paid, financial assets at fair value. Then we have the trade receivables and payables, allowance for doubtful debts, bank. Then we have the buildings. We have the furnitures and fittings, motor vehicles, provision for depreciation, that is for furnitures and fittings, and also for motor vehicles. We have debenture interest, and we have investment income. Now, the cost and net realizable value of inventory as at 31st May 2015 was 4.2 and 39.50 respectively. Invoices received amounting to 500,000 and erroneously been treated as invoice issued. Depreciation is to be provided as follows. We have for the assets and we have for the rate per annum. Furnitures and fitting we've been given as 10%, reducing balance basis. Motor vehicles 20% straight line basis. Allowance for doubtful debts is to be adjusted to 300,000. Irrecoverable debts amounting to 50,000 to be written off. Insurance amounting to 600,000 had been paid to cater for a period of 1 year ending 31st August 2015. Provision for accrued debenture interest and preference dividends are to be made. Corporate tax for the year ended is estimated as 1750. A final dividend of 10% was declared. And I said in this case, the dividend will only be declared for the what? Ordinary shareholders. But for the one for the preference shareholders, it is supposed to be paid at a fixed what? Fixed rate. You are required income statement for the year ended 30th May 2015. So I will begin with that. Remember, you're supposed to begin with the name of the company, which in this case is Fixen Limited. Fixen Limited. In this case, we begin with the income statement. Income statement for the year ended. This is the year ended 31st May 2015. That is now how you're supposed to begin it. So shillings in this case is given in thousands. So we'll have shillings in thousands, and also shillings in thousands. Now, before we begin there is one thing that I want you to differentiate here. There is invoice issued and there is what we call the invoice received. Invoice issued and invoice received. Now, when we talk about the invoice, unajua inapeanwa because of a deni. Sawa sawa. So when you issue an invoice, this is whereby you are giving to a credit what? Customer. When you are giving to a customer, mwenye amenunua goods on credit unampea invoice. That is invoice issue. Kumaanisha lazima kukuwe na goods ulimuuzia on credit for him to get that invoice. That is invoice issue. Then kuna invoice received. Invoice received in this case is now what will be given by who? The supplier. Now the supplier in this case will give you an invoice. You ulinunua goods on what? Credit. Kumaanisha in that case, this is giving rise to what we call the creditor. This one is a what? A debtor. So in our case, when you take on additional information number 2, invoice received amounting to 500 had been erroneously been treated as what? Invoice issued. So in this case, instead of treating it as a invoice received, they took it as a what? Invoice issued. So what does that mean? If it was an invoice issued, is it affecting the sales? Or if it's in this case, it was an invoice received, is it affecting the purchases? So what we'll do here, we'll first begin with the sales. And the sales in this case were amounting to how much? The sales in this case were amounting, we've been given the purchases and sales, which were of how much? 56,955. That is the sales. So in this case, since this invoice was treated as invoice issue, ni kumaanisha wali treat kama credit sale, which in this case it increased the sales. Are we together? However, this is a credit purchase, which in this case, when you purchase on credit, that is when you will be issued with an invoice. You will receive an invoice. So instead of treating it as a credit purchase, they treated it as a what? Credit, that is a credit sale. So in this case, for this one, you will less that invoice received, which in this case was of how much? 500. Because in this case, ilikuwa may increase the sales. However, it was not an invoice issued. It was invoice received. So in that case, this will now give you, this one will give you 56,455. And this is now the net sales. Net sales, which will take them here, 56,455. That is the net sales. We know we're supposed to less the cost of sales. Cost of sales. Now, cost of sales in this case comprises of what? The opening inventory. And opening inventory in this case was of how much? Opening inventory here, we were given from the trial balance is 4185, which is just below the goodwill. That is the opening inventory. You add purchases. Now, when you talk of the purchases here, we were also given, they were 33,270. You will less that, you will add that purchases. In our case, I don't see whether, but if there was carriage inwards, you know you're supposed to add the carriage inwards. In our case, we don't have any carriage inwards. Carriage inwards in this case will arise when you buy goods from the supplier atakuletea kuwekea hapo, kuna mwenye atabeba aweke kwa store. That is how what we call in the carriage inwards, which in this case it also increasing the purchases. Then there is also return outwards. Return outwards. Now, return outwards in this case, I think we also didn't have the return outwards, but if it was there, in that case, you are supposed to less. And then from there, you can now less the closing word. Before that, you have now to add the invoice received. Remember, in this case, it was a credit purchase. It is not supposed to be a credit sale. So unaitoa hapa, unakuja kui-add mali inafaa kuwa 500, which in that case is supposed to be there. So after that, now you can less the closing inventory. And the closing inventory, listen here. When you check on additional information number 1, the cost and net realizable value of the inventory as at 31st May 2015. That 1st May is our end of the year, which in this case we want to know the closing inventory, was 4,200. So this is now the cost, and then 3950, which in this case, this is the net worth, realizable value. Now, when you are valuing stock, in this case, stock is normally valued at the lower of either the cost or the net worth, realizable value. Whichever is lower is what you take as the closing inventory. I will repeat again. The closing stock or inventory in this case will be valued at the lower of cost and net realizable value. Whichever is lower is what you will take as the closing inventory. And in our case, the net realizable value is the lower. So in that case, I will minus that 950. And in that case, it will give me the cost of sales, which will be 4185. I add 33,270. I add 500, then I minus that 950, which in this case it will be 34,005. So when you less that, what you will get here is the gross profit. The gross profit. And what will be our gross profit? Will be 56,455 minus answer, which in that case it is 22,450. 22,450. That is the gross profit. So what you will normally add here, you add other incomes. You add other incomes. Any income. So other incomes in this case, first you have to begin with the discount received. Discount received. Now, go to where we have in the discounts. This is how the examiner tricks you. When you check on the discount, now on the trial balance, there are two zeros. Kuna zero ya kwanza na kuna ya pili. What we have in that on that side, that is what we call the debit side, and there is a credit side. Are we together? The debit side and the credit side. I want you to differentiate these. Now, this one you have to get it from what we call the rule of debit and credit. Once you understand the rule of debit and credit, you will be able to identify which is the discount allowed and which is the discount received. So for the rule of debit and credit, let me just have it here. The rule of debit and credit. Now for the rule of debit and credit, the rule of debit and credit. the rule of debit and credit. That is what you need to understand here. So if in this case, it may either increase or decrease. So if in this case, an asset increases, you're supposed to do what? Debit, you credit. Why will you debit? It is increasing the value of that asset. When it is a liability, this, remember, is something that you are supposed to pay out. Whatever you are supposed to benefit is what you debit. Whatever you're not benefiting, you are paying out. In that case, that is what you crediting. Remember, in this case, come in a decrease, if a decrease as a result of depreciation. So if it is a liability and it increases, you will credit, then you debit. If it is an expense, you will debit, then you do what? Credit. So, reason why we debit in this expense, come on, expense that you are debiting, you are paying it for something that you received benefit of. Come on, and like for example, advertising. You advertise for something in order to benefit you. And that's why we are debiting it, then we credit that. If it is an income, you will credit, then you will debit. Then if it is sales, you will credit, then you will debit. Now, listen here. Now, there is two things that you have to understand in this case. For example, on discount, there is what we call the discount allowed, and there is the discount received. Now, discount allowed in this case, this is the one that you allow to the customer. So when you allow to the customer, ni kumaanisha hata kulipa, kwa hivyo kwako itakuwa expense. Because you have told the customer not to pay that amount. Into you, it will be an expense. And therefore, when an expense increases, it is supposed to be on the debit. Kumaanisha whatever is going to be on the debit side, hiyo itakuwa discount allowed. Now, there is what we call the discount received. Discount received in this case, this is now what is given by the supplier. Ni kumaanisha utamlipa hiyo amount, you will receive it as an income to you. Sawa sawa. So for the income, whatever increases in this case will be what? Credit side. So whatever is on the credit side, that is now the discount received. Sawa sawa. And this is how you differentiate. Anything that is relating to the supplier or creditor is supposed to be on the credit side. What is relating to the customer is always on the debit side. Kama ni return inwards, zitakuwa debit side. Kama ni return outwards, credit side, because it's relating to the supplier. So in that case, what was the discount received? 700 and what? On the credit side. Then also when you check there, we have investment income. Investment income. Investment income is the second line, the last line from the trial balance, which is still on the credit side, which is 4200. Then from there, we continue. We go to allowance for doubtful debts. Now, allowance for doubtful debts. Allowance for doubtful debts. Now, there is what we call the decrease in allowance for doubtful debts. Now, when you talk of doubtful debts, these are those credit customers when you umeuzia, but you are in doubt these customers are not going to pay. So, when you are in doubt, you either look for increase or the decrease. Whereby if it is an increase, you will take it as an expense. Decrease, itakuwa income. Why? Like for example, when you check on our case from the trial balance, allowance for doubtful debts was 420. But on additional information number 4, it was adjusted to how much? 300. On additional information number 4. So imetoka 420, ikaenda 300. What could be the reason? Some of the debtors wenye ulikuwa unaona hawatalipa wamelipa, and that is why it has reduced. Wakilipa kwako itakuwa income, and that is why we taking it as an income, and therefore it will be 120, which in that case is a decrease. We don't have any other income, and therefore after that you get the total incomes. The total incomes, which in this case will be 22,450. You add 753, you add 4,200, then 120, which in this case it is 27,523. That is now the total incomes. So from there now you less the expenses. You less expenses. You less expenses. In this case, I can have shillings in thousands, and also shillings in thousands. Now we are on the expenses. Now for expenses, you begin with the one in the additional information. Now in the one in the additional information, begin with additional information. And number one, we talked about it. Number two, we've also talked about it. We can now get to the number 3, which is depreciation. Now, depreciation is the loss of value of an non-current asset. And there are 2 methods of depreciation. There is the straight line method and there is reducing balance method. Straight line method is when depreciation is charged on cost. Reducing balance is when depreciation is charged on the net book value. What we mean in this case is just the cost minus the accumulated depreciation. We begin with number 1, which is furnitures and what? Furnitures and fittings. Now for the furnitures and fitting, it is 10% reducing balance basis. So when we talk of reducing balance, I've said depreciation is on net book value. So in that case, I will just take 10%. I look for the net book value, and net book value is just the cost minus the accumulated depreciation. So for the cost of furnitures and fitting is 2250. But the accumulated depreciation is also the provision for depreciation, which in that case we've been given as how much? 450. 450. So we have senior building up, you can see we have the furnitures and fitting, which is 2250. And then we have the provision for depreciation. So when you take this cost minus the 450, provision for depreciation, which is the accumulated depreciation, you will get the net book value. And after you get the net book value, from there, you can get the depreciation, which in that case will be 180. Then we also have the motor vehicle. Now for the motor vehicles, the depreciation is on the straight line. And the straight line in this case, we've said, is on cost. So you multiply by the cost of the motor vehicles, which in this case is 12,000. So if I take 12,000, I multiply by 20%, to give you 24, and that will be the depreciation for that case. Then we also have on allowance for doubtful debts. In this case, we've realized is our what? Allowance for doubtful debts on additional information number 4 was a decrease. However, if it was an increase in allowance for doubtful debts, you will also have it where? Increase in allowance. Allowance for bad debts. you will also take it there. That is where it's supposed to be. But in our case, it was not an increase. So a minute we change the battery. So we continue. Additional information number 5. Additional information number 5. Now, on additional information number 5, we've been given there the irrecoverable debts amounting to 50,000 to be written off. Irrecoverable debts, these are what we call the bad debts, which in this case completely you will not recover, the customer is not going to pay. And in this case, it was of how much? It was of 50,000. So you have also to check on the trial balance whether there was any bad debt written off. However, in our case, it was not there. So for the bad debt, it will be what? 50,000. Then we also have insurance. Now, from the trial balance, we have it as rate and insurance. Now, whatever is on the trial balance, it is what the company paid. So when you check on the trial balance, the company in this case, for the rates and insurance, they are paid 25.53. That is what they are paid, 25.53. But on the additional information number 6, insurance amounting to 600,000 had been paid to cater for one period of 1 year, ending 31st August 2018. So what was paid of 600,000, in this case, it is to cover for 1 year. Kumaanisha, if in that case it is ending 31st August 2015, it was paid to start from what? 1st of September 2014. Sawa. But now in our case, our year is ending when? Our year is ending 31st May 2015. Kumaanisha, in this case, there is what they are paid in advance. Payment in advance. Advance itakuwa ya how many months? From May, that is June, July, and for the August, 3 months. Sawa sawa. And remember, when you are preparing the financial statements here, you have to apply the accounting concept we call the matching concept. Revenue should be matched with the expenses that were incurred in the same accounting period. So for the 3 months is not for this period, is for the next period, which in this case we have to eliminate for those 3 months. Itakuwa prepayment. And how will you go? No, the cost for the 3 months. I will come here. If it is covering for the whole year, that was 600, covering for the whole year. 600 is what is covering for the whole year. A year is having how many months? First, we get to know per month, itakuwa ngapi. And then after that, we multiply by how many months? 3 months. Because we have to less that prepayment of those 3 months, which in that case, it will be 600. You divide by 12, you multiply by 3. So for this one, it is 150. That is the prepayment. So I take 25.53 minus the prepayment, which in this case will be 24.03. 24.03. Then we continue. Provision for accrued debenture interest. First, let's know the debenture interest. Now, in this case, when we talk of debentures, debentures are just like loans. However, in this case, a person cannot give a debenture. Only limited companies are the ones that are allowed to give out debentures. Because debenture is only, you have to get debenture certificate from the government. And once you get the debenture certificate from the government, you are now required to issue the debentures. Debentures in this case are just like loans. Are we together? So in that case, for the debentures here, what you just go to the debentures, which is on the trial balance on the third number there, 10% debentures. So the interest on debenture is only 10%. That is 10% of the total debenture. And the total debenture in that case, we've been given there as 1,500. That is the total debenture. Maanisha in this case, the total debenture interest will be how much? Will be 150. But when you check on the trial balance, second last line, I said whatever is on the trial balance is what they are paid. So you can check on that case, we are having the debenture interest. So in that case, there is what was paid. They paid how much? 75. Kumaanisha, still there is what is what? Accrued of 75 for us to give us a total of what? 150. Remember, under the accrual concept, the expenses should be recognized when incurred. So in this case, the debenture was incurred for that year. Is only that for these 75, they have not paid, and therefore that is what you're supposed to do. Then we have preference dividends are to be made. Dividends are paid out of the profits. So first you have to get the profits, and then you do that. Same case to tax and dividends. So after that, you will go to the trial balance and you check for the expenses that you have not included in this case. So from out there, I can see we have the discount what? Allowed now, which is now on the debit side. And discount allowed on the debit side is an amount of how much? It is 510. We also have the salaries. We also have the salaries. Salaries in this case, which is 42.75. We also have the office expenses, rates and insurance. We've also talked about that. We'll not repeat it. Office expenses, which is 22.08. Directors' remunerations. Directors' remuneration. Directors' remuneration, which in this case is a value of 750. We also have interim dividend. Those are not expenses. So at the end of it, we're done with the expenses. So we can get the total of the expenses, which is 180 plus 2,400 plus 50 plus 2,403 plus 150 plus 510 plus 42.75, 22.08, and then you add 750, which in this case will be 12,926. So in that case, you will less, and what you will get there is the profit before tax. What will be the profit before tax? I will take the total income, 27,523. I minus the total expenses, which in this case, it will give us 14,597. That is 14,597. From there now, you can less the corporate what? Tax. So KRA or the government must get its own money. And corporate tax on additional information number 8, we were given as 1,750, which in that case it will be minus 1,750, which in that case is 12,847, which in this case is giving us the profit after tax. So you have now the profits. Now you can pay out the dividends. First dividend to be paid is the preference dividends. Preference dividends. I want you to check on this case. Listen. Now for the preference dividend, we go to the preference shares. They are paying at rate of 10%, and the preference share capital, in that case, we've been given 12,000. So in this case, the total preference dividend that the company is required to pay for the whole of that year, they are supposed to pay 1,200. But when you check on the trial balance, I want you to go to the trial balance. You will realize there is what they paid for the interim. Now on the interim, they paid an amount of how much from the trial balance up in your director's remuneration. They only paid 480. 480. Kumaanisha, there is still the final, which is supposed to be paid at the end, which has not been paid. And that is why we were told that the provision for preference dividends is to be made. And the final, which has not been paid, will just be the 1,200 minus 480, which in this case is 720. When you add that, it is supposed to give us a 1,200. So for this final dividend has not been paid. Therefore, still it is accrued, we'll take it to the current liabilities. And then after that, if there was transfer to general reserve, transfer to general reserve, if it was there, you could transfer that amount there. And then what you get here is now the profits attributable to ordinary shareholders. So this is now what the shareholders are having for them to pay themselves the dividends. So it will be 847 minus 1,200, which in this case is 11,647. This is the amount of money that they are having for them to pay themselves the dividend. So from there, they can pay themselves the dividend, which we call the ordinary what? Ordinary dividend. I want you to differentiate there. Now for the preference shares, they are paid at a fixed rate of dividends. Are we together? But for the ordinary shares, they will only be paid when the dividend is declared. Are we together? So in this case, when you check on the interim, there was what was declared and they were paid. When you check on the interim dividend paid for the ordinary shareholders, they were paid 22.50. That is what was declared at interim. Then there was final, which is the one that we were told on the last additional information number 9. A final dividend of 10% was declared, meaning that in this case, you have to take the 10% of their total preference share capital, which in this case is 22,500. So let me just have it here. This is interim. So for the final will just be 10% of 22,500, which in that case will also be 22,50. Whereby in this case, remember this one I've treated it differently. You have to take 10% because it is paid at a fixed rate. But for this one, for ordinary dividend, it will be paid when declared. So for the first at interim ni katikati ya mwaka, they declared 22.50. And that's why I've written the 22.50. As at the end of the year, which is now what we call the final dividend, they declared a 10%. And that is why we've told a final dividend of 10% was declared. So you also take 10% of the total amount, which in that case it will give you the total. So you can now get the total dividend that was supposed to be paid, which in that case, it will be 45 what? 100. And out of that now, you can get the retained profit for the year. So the retained profit for the year, what they will retain for that year will be 11,647 minus 45. So they will retain 7147. That is what they are going to retain for this year. Then you have to add what they retain from the previous years. You'll have to add the retained profits, or what we call the revenue what? Revenue reserves balance brought down yenye walitoka nayo from the previous year. So we've been given the revenue reserves. So from the previous year, walikuwa wame retain 224.30. So you can now get the revenue reserves. Revenue reserves balance carried down, which in this case, it will be 7147 minus 24.30, which in that case, it will be 95.77. And that is now how you're supposed to prepare the income statement. The income statement. Now, from there, we can also prepare the other one, which in this case you may be also asked, is a statement of changes in equity. Now, if you are asked about the statement of changes in equity, this is how you prepare it. However, in our case, you've not been asked. So if you are not asked, you don't have to waste your time on the same. There is the statement of changes in equity. So this is fixed and limited, and I am on the statement of changes in equity. Statement of changes in equity. And this is for the year. The year ended. The year ended 31st May 2015. Statement of changes in equity. Now, in this case, you always base on the equity items. And the equity items that I've said here, we only have this item, the ordinary shares, the share premium, general reserves, kama iko, general reserves, and then we'll also have the revenue reserves. Revenue, or first you can have if there was revaluation reserve, a revaluation reserve, and then revenue reserves, revenue reserve. So in this case, shillings, revenue reserves are also the retained earnings. They are also the retained profits, as I've said. You can have shillings in thousands, shillings in thousands, and then shillings in thousands. So what you normally begin with is their balance brought down. Balance brought down is what you have on the trial balance. So for the ordinary share capital, we have 22,500. The share premium, we have 1,200. General reserve, we have 1,500. We don't have revaluation reserve. Revenue reserve is what we had, 24.30. Then from there, you will also have the profits after tax. That is the profit after tax. Profit after tax in this case will only increase the retained earnings, which are revenue reserve. So in that case, it will only increase there. And the profit after tax in this case was 847. 847. That is the profit after tax. Then you may also be told there was a transfer to general reserves. If in our case there was a transfer to general reserve, hiyo pesa unaitoanga hapa, unaileta kwa general reserve. That is where you will remove that amount of cash there, you will come and add it there. That is the transfer to general reserve. Then remember, there is the preference dividend. Dividends are paid out of the retained earnings, and therefore in this case, this one will only affect the what? Retained earnings. Whereby in this case, the total is supposed to pay 1,200, will less 1,200. And then also, if the ordinary dividend is also supposed to be paid out of this, and the total which was supposed to be paid is of 45. So after that, what you will get there is now the balance carried down, which you will take to the statement of financial position. 22,500, 1,200, 1,500. Hapo hakuna. And this one will just be the same as what we have in there, 95.77. That is what will be the statement of financial position. Now, of changes in equity, I mean. Now, we can now talk of the last point, which is now the statement of changes in statement of financial position. Statement of financial position. This is as at statement of financial position as at that 1st May 2015. 31st May 2015. So in this case, I can have shillings in thousands and also have shillings in thousands. So we begin with the assets. And in this case, we'll have what we call the non-current what? Non-current assets. Non-current assets. So for the non-current assets from the trial balance, uko mwisho mwisho, and see we have buildings. So the buildings in this case were not depreciated, so we'll just put the total amount, 25,500. Then we have also the furnitures and fittings. Furnitures and fittings. So for the furnitures and fitting, the amount in this case was of how much? The amount in this case, we were given the cost. The cost was 2250. So remember, we take 2250, we less the total book net accumulated depreciation. We have to present them at the net book value. So the accumulated depreciation for the furnitures and fitting was 450, and depreciation for the year was 180. This amount, which in this case it will give us how much? It will be 450 plus 180, whereby in that case we take 2250 minus answer, which in that case it will be 1620. We also have what we call the motor vehicles. The same case, we present them at their net book value. Motor vehicle, the cost was 12,000. You less the total accumulated depreciation. The accumulated depreciation was 4650, and depreciation for this year was 2400. So in that case, it will be 4650 minus plus 2400, then 12,000 minus answer, which in that case, it will be 4950. Then after that, we also have what we call the goodwill. Goodwill in this case is always an intangible non-current asset. And the goodwill in this case was amounting to, the goodwill we were given there, 3750. Those are the non-current assets. We go to current assets. Current assets. So for the current assets, you begin with the inventory, which in this case is the closing inventory, which was 3950, the net realizable value. Then we also have the trade receivables, which in this case, trade receivables. Now for the trade receivable from the trial balance, trade receivable from the trial balance was 3600. Now, the thing that you have to list in this case first, it was the invoice received. Invoice received in this case was treated as an invoice issue, which in that case, it increased the trade receivables. Sindio? When you issue an invoice in kumaanisha, you have sold the goods on credit, which has increased that one. Therefore, first thing, you less the invoice received. Then, when you check also on additional information number 4, allowance for doubtful debts. In this case, there are those that you are not expected to receive, where it was adjusted to. It was adjusted to 300. So in that case, and on additional information number 4, you will less that. And then there was also bad debts that were written off of 50. Out of these are the amount that you are expecting not to receive. So you get the balance, which is 3600 minus 500 minus 300 minus 50, which is 2750. Then we also have the bank balance. Bank balance. We have bank balance. Bank balance, we were given 1917. We don't have cash in hand. We don't have cash in hand, but we had prepaid insurance for the 3 months. Prepaid insurance, and this was for the 3 months. And for the 3 months, the prepaid insurance was of how much? 150. So you'll also add 150. So with that, you can get now the total. Now, we've also forgotten something here. There is what we call the financial assets. Before I talk about that, there is financial assets. And that is at fair value. We also treat them as current assets. Financial assets, which in this case is 12,000. We also have now the prepaid insurance of 150. So in that case, you can get the total assets. Total assets. So what will be the total assets? 25,500 plus 1620 plus 4950 plus 3750 plus 3950 plus 2750 plus 1917 plus 12,000 plus 150, which in this case is 56,587. 56,587. Now, we can also prepare the statement of financial position. I'll just wrap up this statement of, the equity and liabilities, the part for equity and liabilities. So I begin with the part for the equity and liabilities. Now, in this case, we don't use the capital, but we talk of equity and what? Because of the reserves, liabilities. So for equity and liabilities, first you have to begin with the ordinary what? Ordinary shares. Now, in this case, you have already the balances. The balances is the one that you prepared on the statement of changes in equity, which is 22,500. We also have the preference shares. Preference shares. Now, for preference shares from the trial balance is 12,000. We also have it there. We have the share premium. Share premium. Share premium. And for the share premium, in this case, we have the balance there as 1,200. We also have the general reserve. The general reserve. General reserve, which is also 1,500. And then we have the revenue reserve. Revenue reserve, which is the retained earnings, and is 95.77. 95.77. From there, you go to the non-current liabilities. Liabilities. And on the non-current liabilities, we have the 10% debenture, 10% debentures. And for the debentures in this case was also an amount of 1,200. You'll also have the 1,200. Then we go to current liabilities. So for the current liabilities, we have the trade payables. Trade payables. From the trial balance, we were given 30.15. But remember, there was that invoice received, which was treated as invoice issued. And the invoice received, remember, it increases the credits, which in that case will be 500. So in that case, it will be 35.15. Then there was also accrued debenture interest. Accrued debenture interest. The accrued debenture interest, they pay 75. They have not paid the other 75. You will also have it there. There was also, when you check on the trial balance, we don't have any corporate tax that was paid. Therefore, this corporate tax is not paid, which was of 1750. So we'll also have the corporate tax payable. And then the last one, we have proposed dividends, which was supposed to be paid both for the interim and both for the preference, which was for preference, they didn't pay the 720, and then for the ordinary, they didn't pay the 2250. They didn't pay the 2250. So it is 720. You add 720, 2250, which in that case, it is 2970. So there is nothing that I think we've omitted in that case. So you can get the total equity and liabilities. Equity and liabilities. Total equity and liabilities. So it will be 2970, 1750 plus 75 plus 3515 plus 1200 9577 plus 1500 1200 plus 12,000 plus 22,500, which in this case is 56. 56. This is given 285, 287. Let me repeat again. It will be given by, we have 22,500 plus 12,000 plus 1,200 plus 1,500 plus 97, 95, 77, 1,200 plus 35, 15 plus 75, 1,750 plus 2970, which is giving us a difference of 356,587. There is a difference of 300. Difference of 300. I think that's the allowance for doubtful debts. So this 3,600 minus 500 minus 300 minus 50, 2,750. So this is 25,500 plus 1,620, 950, 3,750 plus 3,950, 750, 1917. We have 1,200. $587. This is giving us, so there is a difference of 300, which I'm trying to check on where what we've omitted for 80 plus 720. So this is 720. This is, I think that is okay. For the accruals, we've taken all the amount, that is 150. And I think closing inventory is okay. For the purchases is okay. I think it's supposed to be that way, but it's supposed to balance. So 4650 plus 20. This is for inventory. Or was there any cash? Check the share premium, goodwill, purchases, bank is okay, furniture and fitting, investment income. I think, yeah, we've included everything. Yeah, that is how it's supposed to be done. That is how the question is supposed to be done. So any question on that regard? Only benches is what? Is just okay. For debentures, I think is okay, because when you take 10% of this, 1,500 will be 150. Remember what they paid was 75. So what is accrued is supposed to be what? What is accrued in this case is supposed to be 75. And that is what is here. So I think it's supposed to be that, and we'll be able to continue from there in our next class.